higher oil prices, while bad for consumer inflation, is good for energy equities.
There's going to be a minimum slowdown in economic growth, and earnings estimates are not pricing that in.
When I look at earnings revisions now, they're actually trending up.
The excess savings declining. San Francisco Fed thinks it hits zero by the end of this year.
You've got consumer spending that's very resilient. A 10% pullback, if we do get that, gets bought just like that.
We've talked about the student loan moratorium ending. That's ending right now, and the first payments come in October.
There is a risk that, for example, headline inflation starts to creep back higher.
We've talked about these payments having the interest rates rolling on commercial real estate. There's about $1 trillion coming due in the next 2 years.
That doesn't typically tilt the economy into a recession.
We talk about tightening lending standards. That's not something that hits the economy right away. That takes time. That's a lag.
Everybody worries about these lagged effects. Well, most consumers are paying mortgage rates that are in the 3s or maybe 2s.
This is a late cycle economy. We've looked back, and I would define the cycle by unemployment rate and how much you've grown since the last recession. We're at the historic low unemployment rate, and nominal growth has already risen 40% since the recession of 2020. Number two is people talk about the delayed impact from rate hikes as being kind of not a big deal. We think it's pretty significant because it really has effects on the consumer, on businesses, on commercial real estate, where all of their paper gets rolled. Over the next 2 years, you're going to be rolling a lot of 0% paper into today's interest rate. And it's not only the consumer and businesses, but it's also the federal government, who has a exploding deficit, which is going to significantly increase the amount of treasuries they're going to have to issue. And that's part of the reason why we're seeing the higher interest rates. And that capital has to come from somewhere in order to absorb that supply. And I think equities will be one of those places.
I'm on the bullish side. I think a 10% pullback, if we do get that, gets bought just like that. I mean, if you think about the market in August, we corrected 4 or 5%, and you fast forward, if you're on vacation, you blinked and you missed it. The stocks are almost back to their highs from earlier this summer. And the reason, Scott, why I think any pullback gets bought, and I'm not in the bearish camp, is because, look, this economy, I don't think is heading into an imminent recession. You've got the third quarter GDP that's on track for 5.6%. You've got consumer spending that's very resilient. And, the biggest thing that makes me say that I don't think we're headed for a recession is that the Fed is maybe just getting too restrictive. Yes, rates are at 5.5%, but if you account for what the neutral rate is, what inflation is, we might just be slightly restrictive. So that doesn't typically tilt the economy into a recession. So that may not be a 2024 event.
And you think that can last?
It's all about employment, and the consumer is gainfully employed. It's fully employed. And yes, the unemployment rate is 3.8%, but the only reason for that is that more people. We had a spike. More reason for that is because we had more people enter the labor force. You've got wage growth that is strong. And I think probably the biggest reason why the consumer has been so resilient, everybody worries about these lagged effects. Well, most consumers are paying mortgage rates that are in the 3s or maybe 2s. Most consumers not seeing this big reset higher in debt expenses. And so why should a consumer that's gainfully employed all of a sudden tighten the belts all that much?
How do you, even under that optimistic scenario, justify current valuations?
I think valuations are full and they're fair. I think they're fair for the current level of rates. They're fair for the current level of growth. And I think they're fair for what the forward-looking earnings expectations may be. And obviously there's distinctions within the sectors. But if I look at tech, for example, we all worry about tech valuations. But if I have a company that is growing their earnings at 10, 12, 20% versus the S&P 500 that is maybe growing the earnings at 5 to 10%, of course I'm going to pay a higher multiple for the higher growth company.
But you're not worried about the fact that earnings growth in the very companies you're talking about has been coming in, not going up?
That was the case earlier this year. That was the case in 2022. But when I look at earnings revisions now, they're actually trending up versus down. That's true for technology. That's true for cyclicals. If you look at consensus GDP forecast for this quarter, it was virtually 0.5%, 1%. It's moved higher to 2%, but there's still this delta between the nowcast that's at 5.6%. So the reason I bring that up is because as analysts have been behind the curve forecasting sluggish economy and the economy surprised to the upside, they're now having to revise. The equity analysts are having to revise their earnings estimates higher. So I think we're actually in a positive part of the earnings revision cycle. I am a believer in tech, and partially because of the secular growth and the artificial intelligence, and I want to have that in my portfolio. But that probably can't be the only thing, because there is a risk that, for example, headline inflation starts to creep back higher. And by the way, the culprit of that is going to be energy. So I do want to have some energy in the portfolio. And I think Saudi Arabia, Russia pact today really shows you that that alliance wants to keep oil prices elevated. And higher oil prices, while bad for consumer inflation, is good for energy equities.